worry future. We're talking real money.
Travel with me back in time to the year 2007. Don McDonald is elected as treasurer of his homeowners association, and ever concerned about the quality of the investment portfolio of everyone, including our HOA, I called our financial advisor for the HOA in Phoenix. Worked for, who did he work for? I'm trying to remember. I think it was A.G. Edwards at the time or something. I said, where's our money? He said, your assets are invested in incredibly safe auction rate notes. Higher yield, but daily liquidity. And I said, tell me more. Well, it turned out, he said, these are, like 10-year average maturity bonds from municipalities and riskier entities. But because you can get there's a daily auction, you can always get out. No matter what, you will be able to get out. Well, in early 2000, I told him, I said, get us out of that and let's just go into money market mutual funds because this is our cash we need for stuff. I can't have it in long-term securities. He kept saying, no, don't worry. They've got liquidity. Well, anyway, in 2008, if you'll recall, the financial crisis was it's getting started. Big banks that have been buying up the securities at these auctions every day just stopped buying. They didn't want any more risky stuff in their portfolio. And just like that, investors, not us, who thought they had a cash equivalent with a higher yield were stuck with long-term bonds that they could not unload. They were not liquid anymore. Their money was locked up. Nobody wanted it for years. Liquidity, something we don't think about until it kicks us in the financial derriere, Tom.
Yeah, and right now we're looking at all this again because, as you may recall, it's been a pretty bumpy start to the year with publicly traded securities. Sometimes that trickles down to things that are not traded every day and makes it harder. This from the Wall Street Journal. They're packed with brainiacs, but Ivy League colleges sure lack street smarts. Some market wisdom they are about to relearn is, quote, liquidity is always there, except when you need it. Now, got to have the cash.
Like my story.
Yeah.
It was there until you needed it.
Exactly. And you can recall the financial crisis. Harvard's endowment had to come up with cash in a hurry because of its complex investments. It ended up dumping assets at distressed prices and was forced to borrow money. University endowments now are even more committed to the expensive, hard-to-sell alternatives like private equity, which you're hearing more and more about as a promotion for your 401k. Last year, Harvard relied on the endowment for 37% of its budget. That's up from about 20% just 20 years ago.
And this year, it's probably going to be even higher without the government funding.
And the donations that will be going down, no doubt, as a result of all this controversy. Well, and as the article points out, exactly what you said, Don, it worked until it didn't. Instead of elite returns, the largest endowment did worst last fiscal years. And it could, as you say, get worse. PE, private equity funds, can make an endowment look good because of a lack of updated market prices. Eventually, though, they must reflect reality, like when a huge client has to sell. Now, these are things, here's the part that's even more fascinating about private equity. The part that you kind of forget. You're investing in, companies that are not publicly traded, right? Things that you couldn't have access to, right?
Right, and the reason for that is because that they can't get access to the public markets because they're riskier.
Yeah, we'll get to that in a minute. So these are micro-cap stocks. You could maybe say small, but they're really, really, really small companies. Here's the part that's even scarier. They are juiced up by borrowed money, many cases, right? So if it's not enough to be scared by a company that is iffy, and we all know some of those, now you've got to add in the juice of these borrowed money. And another one that's awful when it comes to private investment, costs. Investment consultant Richard Ennis estimated in December that Ivy League endowments would have been worth 20% more if they'd invested in the classic stock and bond mix that most people have in their 401 crisis. One of the reasons that alternative funds charge between 3 and 4% to operate, right? I mean, these are illiquid investments that require greater management. So the next time you get all worked out about something new in your 401k, and this is coming, it's coming fast, by the way, because major custodians have already said, yeah, we got to have a part of this because of the money, I think. I hate to be cynical. You really got to watch yourself. Well, I'm going to talk about a few of the reasons for and against this, though, that are fascinating to me that you read in the press.
Well, I just find the whole thing so typical, and this is the kind of thing that happens in the run up to almost any major market shock. And it's usually the most illiquid, the most convoluted, the most complex, the most created, and that's not the word, engineered, the most overly engineered securities.
Good way to put it.
End up really biting you in the derriere. But the problem is they work so well right up until they don't, that there's a great story to tell right up until they don't. And we want to believe it because we're greedy.
Yeah,
Even the people who head up these endowments, they're greedy. Their raise, their reputation all depends on having this incredible track record. And again, I just can't say this enough. Things work until they don't. And we don't always know when we rarely know when they're going to stop working.
Yeah, I mean, the Wall Street Journal put it this way, that private equity now faces a perfect storm. The sums manager owe existing clients are at a record as deal activity slumps. In other words, new money ain't coming in, folks, so they got to take it out another way. But I did a little work around some of the people that are out promoting this stuff, and here are the arguments for using private equity or investing in it. Number one, there are fewer publicly traded companies than there were 20 years ago. So in other words, the aspect of I'll just buy an index fund and invest in the market is not as profound as it used to be because you don't have as many companies to invest in. That's one of their arguments. Number two, they claim, and although I can't find it, that the returns have been greater. Now, you just heard from one expert who said, no, it would have been better just to be in a 60-40 stock bond mix. And then the other one that they really love using, Don, is you get exposed to new technology, new types of companies that are not in the public market. So you don't get a chance to put your money into those and you're missing out on the opportunity. That's the way they put it.
Well, and the other thing about these illiquid securities, the best analogy I can come up with is real estate. Real estate, my home does not trade day to day.
I sure wish my condo did.
But no, my home hasn't traded in 28 years.
Right?
Yeah. So I really do not know. I can guess based on other similar homes what my home might sell for, but I have no clue what my home's value is today. It's not price day today, and I will not know what it's worth until I put it on the market and somebody offers me a price for it. That's the only way I'm going to know the price. And that's the biggest problem with these illiquid securities in these non-publicly traded forms, is that nobody is pricing them except an appraiser, just like my real estate. It gives me an idea where it might be, but the difference between like what Zillow says my house is worth and what a realtor I talk to says it's worth is in the realm of about a 20% difference.
That's substantial, right? 20%
it's like 15 something, 16. It's a substantial difference between. So I can't say my house is worth X because it very well might be worth Z.
Yeah, and I think this is one of the key arguments against private equity. How much risk are you willing to take to make that marginally more money, which we can't tell you if you have or you have not. Back in the day, you mentioned back in the day, few years before that, when I was hosting a program in Seattle on television called Serious Money, every year I got to interview the head of the Washington State Retirement Investment Board, the guy who take all the pension money and invest it in various places. And there were a couple of things I always loved. Number one, they at some point they decided on the public side, public investing side, just to use index funds. At one point I said, why don't you use any of the managers anymore? He said, well, we used to hire the guys with the best returns, but we couldn't get the returns that they'd already done. That was previous. Right. Moving forward, it didn't happen. Number two was the amount of money they continued to put in private investments. It fascinated me. And his rationale was, look, we can show you that with these certain firms, they've been very smart at picking the right companies, et cetera, et cetera. And my argument then was what you just said, until they don't. Now, I don't know how that all turned out, but it was an interesting argument. So that risk that you're taking is the cost you're incurring, and the absolute 100% lack of liquidity, to me, make this a risky bet that I would not take.
Well, and here's this is across the industry, across the financial advice industry, but particularly prevalent in institutions like college endowments. The boards of the endowments and the chair, the manager of the endowments, have to convince people that they're smarter than the market. Otherwise, they don't need to exist.
Exactly.
They have to be smarter, or they have to at least appear to be smarter than the market, or there literally is no point in having them. The university, Harvard, could just say, we are going to buy the total market index for our stock portfolio, the total bond index for our safer portfolio, maybe a real estate index, a REIT index for some real estate exposure. Those three things rebalance every year. And guess what? We can have a bookkeeper do that at $80,000 a year.
And guess what? There are institutions that do this today. There are some that just have like one person there running the whole thing. That's that.
The first analogy that springs to mind for me is the ubiquity of Microsoft computers in businesses, and every one of those businesses has to have an IT department to manage
something here. Yeah,
complexity.
Yeah, exactly.
And the fact that they have back doors and confusing things. And I'm not calling any company into question.
No, you are, but I know who you're talking about, because if I want to add anything to my computer, guess what? I got to get somebody else.
You got to go through IT. If I want to add something to my Mac, I just add it to my Mac. And my Mac says, are you sure? Are you positive? Are you 100% certain?
Yep. Yeah. So, again, the reason that I brought this topic up and I wanted to discuss it is I'm hearing more and more about this in retirement plans. I'm hearing more and more from, as I said, major custodians that are planning to add this as a security that you should invest in. And I recommend be very, 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 I can't say enough, very careful, even considering it.
But again, that goes back to the advisor feeling the need to sound like they possess secret knowledge that only the inner circle can know.
And we're letting you in. I love that.
Priesthood.
Sure.
And there are no secrets. There are no special formulas. You know that deep down inside. You know it. You do not practice alchemy. I have never, ever heard from a single one of you with a garage lab where you're trying to turn lead into gold.
This is your opportunity.
It won't work.
This is your opportunity to do that. So call us and let us know.
If you've got the formula.
I want to know.
But again, wait, I got an even better analogy. Yeah. Let's assume we do have one person in our audience who has the formula to turn lead into gold.
Please call.
Okay?
Yeah.
Would they share that with us?
No. Why would you? Then that
right.
gets back to this.
That's the same argument about Wall Street.
I know.
That if you had the secret to making a lot of money without a lot of risk, why would you share it with your clients?
You wouldn't. You would be just back room counting out the cash. So that's good. So, all right. Thank you for that. We got time for a few questions here. One comes from Antioch, California. This is from Clinton, pardon me. I'm receiving a pension from the state of Alaska. I don't need the money, so I'm wondering where I should put it. I've been receiving it for 2 months, and I understand that it will be taxed, but as of yet, it has not. Now, okay, just to stop there for a moment, because if you're living in California, you're getting income from a pension. I believe if it's, I always forget the pension
No,
rules.
it'll be taxed in California. It
In
depends on where
California.
what your
That's
residence
okay,
is.
right? Yeah, in state of Washington, no, you would not face that.
Right.
But I don't know federally.
What do you mean federally?
Well, in other
what?
words, if you're getting a pension from the state of Alaska and you live in Washington State, do you pay federal taxes on that
federal
income?
taxes on that. Yes.
Yes. Okay. All right.
Yeah.
Just checking. Okay.
Pensions are not tax-free income.
I didn't think so. But okay. I thought it would make sense to put it in my Roth, but since it has not been taxed, then I would be taxed a second time if I put it in my 401k. This is kind of confusing. All right.
I'm totally confused.
Yeah. All right.
Does he have earned income? I didn't hear that.
No, the only income he has is apparently from the pension. So you couldn't do a
so
Roth.
he can't put any money
unless
in a
your
Roth.
spouse had money income, then you could.
Well, right, but let's just assume not. You can't put money in a Roth. You can pay the taxes but you're paying the tax. You will. I mean, when you file your return,
finally they're going to say, guess what?
You got to pay taxes on it.
Yeah.
The only place you could park it would be in a brokerage style account in
after
a proper
tax
portfolio based on you. There is no perfect portfolio for every single person listening to us. We wish there was, but there can't be.
No. And so no to the Roth, yes to the brokerage account, as Don said, and then it would be around what your potential needs of that money are as well. Because this gets back to what you just said. There is no one portfolio, because do you need this in 5 years? Is this going to be left there for 20 years? All those kind of things play into how to design the portfolio. Navin writes us from Orlando, Florida. Apparently you've heard of that place, right? It's not too far away. Right up the road.
If I had windows, I could almost see to it.
Ooh, hello, Tom and Don. Love the show. Appreciate the thoughtful guidance you give to personal finance. Exploring whether to invest $250,000 in capital gains from a recent equity sale into a qualified opportunity zone, QOZ, to take advantage of the deferral and potential tax-free growth benefits. I understand the capital gains deferral runs through 2026, and the 10-year hold could eliminate gains on the new investment, but I'm wrestling with the illiquidity, potential risks, and realistic return expectations. Now, qualified opportunity zones. I looked at this, as you may remember.
I know.
I think we discussed it.
Didn't you put money into one
of
these?
No, I did not. No. I looked at it. I didn't like the illiquidity. It felt like it was one of those instruments where you're kicking the can down the road on the tax aspect. You're getting the benefit.
You're merely kicking it down the road, too.
And that was my take. Like, why would I do this? Just get over it, pay the tax, invest it properly, and get on with it. We have clients that have some of these. I don't favor them. We don't buy them for people. We don't use them in our portfolio. So, no, this wouldn't be something I'd be loving. But what about you, Don?
Well, okay, there are so many problems here. One, the relative complexity of these products. Some could have good potential. Some are going to collapse completely.
Some don't work. That was the other part of it.
Some don't work, and the average expenses for QOZ funds are right around 2% a year. So the fees are onerous. The illiquidity is obvious. The opacity is pretty intense. And the money is going into oh gosh, how can I say this?
It's
politically
being
correct?
It's okay. Go ahead.
No, Tom and I both read a recent book about the Trump family.
Yes,
and Fred Trump, Donald Trump's father, took advantage of many of these kinds of deals.
He did. Yeah.
That were to improve real estate for lower income housing and things.
That's correct. Yeah.
And you'll read that while probably some of them are great, many of these things are used corruptly.
Yep.
They're
sham.
misused.
Yep.
Yeah. So
I decided not to when I had at that place almost 5 years ago. So no, but
this to me, it sounds to me like this is a pretty substantial, and I'm just reading between the lines, a pretty substantial part of your net worth. And I would absolutely
100% no way. But again, the reason most people do this is to pay the tax
of your net worth.
Oh yeah,
maybe.
Sure. Is this Jeff Bezos who wrote us?
Yeah, but if it's 20% or 30? No way, ever.
But it always gets back to this aspect of, is it worth buying an investment, making an investment just to avoid taxes?
It's
I
the
decided
tax
at the
tail
time,
wagging the dog.
right, I decided, nah, pay the tax, invest it properly, get on with it. That's the way I looked at it. But many people do not. I don't like
Well,
operating
here's
that way.
my thinking is it's the whole bird in the hand thing. I've made the money.
Yeah.
I have a profit. As part of this system, I owe taxes on that profit to keep the rest of the world humming along. I'm going to have to pay them eventually anyway. I know I have already won. I won. I made money.
Yep.
Do I want to take a chance I'm going to lose now that money?
Yeah. And just to avoid paying the capital gains tax today.
Right. Which worst case scenario
Right.
is going to be about 20%.
Yeah. No. And so you and I both bit down. I did look at it and I did talk to somebody about them, but I decided not to. So, all right. Jason, can we squeeze in one more real quick?
Yeah.
From
It's a podcast. We can do whatever we want.
Cove, Texas. Writes, hi, Don and Tom. I believe your crowd will be interested in this future feature that Fidelity has. Fidelity has a CD ladder tool for terms of 1, 2, and 5 years. He provided a link, fidelity.com/fixed-income-bonds/CD-ladders. Please give me your thoughts about this.
That's way too much. What you can do is you just go to the web and you type in Fidelity CD ladder, and then there it comes. I just did it. I went Fidelity CD ladder. There's the link. Build the 5-year ladder. Schwab has one of these too, and I use it. I
didn't think this was unique. He says he's eyeballing the 1-year ladder for his emergency fund of $32,000.
That makes sense.
In the Fidelity high yield savings account SPACs, which we're well aware of, at 3.9%.
For the 1 year, the immediate, I might need it right now money.
Exactly.
Then but the other thing you could do is just say, okay, as a portion of my cash, I'm going to up the number, have that first year CD that's coming due be my emergency money, and then do a 5-year ladder.
Yeah, there you go.
Because then you maintain an average yield that is more stable. Because with a 1-year ladder, your average yield is going to fluctuate a great deal because of the short-term nature of the CDs.
But you do this on your own. You don't use the Fidelity or the Schwab ladder.
I use the Schwab tool.
Oh, you do use the tool. Okay, I thought you were just out there buying those bonds,
No.
bonds.
I use the Schwab tool. It's really nice. It's really easy to use. It goes out and hunts up the best CDs for me. It shows me all about them. I can check for call features. You don't want a call feature. You want to get the whole term. That's how ladders work. No tricks, no gimmicks, no putability, no callability. Just a straightforward CD insured up to $250,000.
And you know what I do? Even easier than that? I use a thing called a bond fund. They do that inside there. I pay them a tiny little bit, and they take care of all that hard work. So anyway. But
both work.
It's fine either way. All right. That's all the questions I have. That's all the comments I have, doggone it. But I have one more thing, because I've talked to a lot of you the last month and a half who have been worried about the volatility in stocks. Now, volatility, as we've tried to tell you on this program many times, is the reason you've made more money in stocks than in other instruments. That's fine. But if you're worried and you don't have a plan, I run into a lot of people that say, well, I've got this much. They don't have a plan that matches their asset allocation. That's what you need. And that's the work that we do. And by the way, free conversation with myself or any advisor. Give you an hour of our time. And if you walk away and say, I got it figured out, great. Or I need somebody to write a plan, or I need help, we're happy to do all those things. And it's pretty doggone easy. You just go to talkingrealmoney.com and click on Meet an Advisor. Click on Meet an Advisor. It's right there.
And please remember.
Please.
Volatility is your friend. You want volatility. You may not like volatility, but this is so important for you to remember. It's the volatility that makes for the returns. If there wasn't volatility, the returns from stocks would not have been anywhere near as high as they have been. There must be uncertainty for investors to expect a potential long-term reward. reward must have risk associated with it.
Yeah. Otherwise, you're going to get 4%.
Otherwise, you're getting an indexed annuity.
Yeah. Oh, please. Now you have to ruin the show that way? Come on.
I did. Yeah.
Kill me.
Thank you all for being a part of this episode. Please, and by the way, please don't send me nasty letters if you're a tech support person, an IT person.
We don't hate you. We just
don't
think you're
hate
pain
you.
in the you-know-what. That's all.
I really do think IT is a pain. It's like every time I have to call for you, my Luddite friend.
Only 3 or 4 times a day. It's not that bad. Come on. On those days, I can't find my Gen Z person here in the office to come in and say, here's how you click
Can
it,
you
sir.
please get yourself a designated Gen Z in-office helper bee?
You know, they keep moving those people further and further away from
you. Yeah.
They're smart.
Anyway, so please don't be angry. I was joking around. I know you guys you do an important
We love
job.
you too. Yeah, it's good.
Just don't do it. Here's what I would ask. Get it
out there. What is it? Yeah.
All right.
Yeah.
This is particularly true for online tech support people for various technology products.
Yeah.
Quit saying it's always my fault.
Well, that's what you say to me.
Well, because you don't know what you're doing. I do.
So in my case, it is my fault.
And it's
yours
so funny because so many times I'll go, no, it's not my fault. And then I'll do all the stuff. And then they'll go, maybe you were the first person to report this problem. And I'm going, how can I be the first one?
Aren't there like 7 billion people in the world or something? God's sakes. Okay.
I'm not.
But in my case, I am the
wrong.
first one because I'm the first
And
one.
by the way,
that.
Please don't ask me if it's plugged in. Yes, it's plugged in.
You can ask me though.
It's always never with. I mean, Tom, did you plug the interface into your computer? Okay. Yeah, that
you're killing
could
me.
explain.
Thank you for your love and support
I
on
need to
this
get you a
program.
new interface.
Exactly.
I need a new audio. Can somebody give me the best idiot-proof audio interface, 2-channel audio?
It still won't work.
Where it requires no plugins, no drivers, no software.
You just walk in and start talking.
Turn it on, and it works.
Wait, turn it on? I got to think about that.
Plug it in. Got to have power.
Okay.
We have not figured out a way to make electronics work with no power source yet. We're working on it.
Okay.
Thank you all.
Soon.
We appreciate you being there. And, we do talk about a lot of stuff, but most of the time we're talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.